Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Welcome to Fridays with Frank and Associates. I am one of those associates, Nigel Grant, back for another quickfire chat on a Friday for everything that's happened during the week. We've got Frank Jasper back with us as usual. Frank, where are you coming to us from this time?
The beautiful Tahuna, Queenstown today.
Oh, it looks lovely. Gosh, it's autumnal there, isn't it? It looks like a magnolia, or maybe to your right, or a red flowered thing. Or
I will take your word for it.
Okay, well, we don't need you to know flowers and tree types. We need you to know some other things. So let's get straight into it. We've got a few things to get through this Friday, but you were meeting with and talking with our teams on Monday, as you do every week, first thing Monday morning. There were a few themes that you talked about that are kind of, and we've talked about on the podcast quite a bit, that sort of like, and BlackRock have kind of led them a little bit for our thinking, but these sort of themes that have, you were saying some of these mega forces, key themes have played out even more strongly than we thought. Let's start with micro and macro and go from there.
Yeah, so one of the theme about the themes that BlackRock has had, and I think we've really seen this play out in markets this year, is that the typical macroeconomic things that we might look at are becoming a little less stable, a little less good to anchor your investment process on. You're better to almost anchor your process on more top-down, big thematics. BlackRock talks about the mega forces as some core thematics to consider, but they also have below the surface some shorter-term themes that they think will dominate nearer term market action. There are three of those that they talk about for 2026, and they've just given us an update on their thinking as of where we stand right now on them. The first of those is this idea that micro has become the new macro. And what does that mean? Boiled down to it, it's really saying that the scale of AI capex, this massive investment that the hyperscalers are making, is so dramatic and having such a broad effect on the economy that it's actually affecting macroeconomic data and it's becoming a core economic driver. And there's certainly nothing in the Q1 earnings results from these companies that would dissuade you from that. The amount of spend is vast and it's having a massive effect on different parts of the market.
Oh, and so when you say something happening at like a company or a sector or a specific level is actually the thing that's driving the whole market at the moment.
Yeah, it's so large that it's actually having a sort of a tangible, noticeable effect on the total macro economy. So you can't think about the pace of US growth right now without thinking about AI, without thinking about how much money the hyperscalers are investing, without thinking about investment into data centers, and then without thinking about the productivity effects that AI will have. So once upon a time, something that you would think is quite a micro consideration, what's happening in technology, is actually beginning to have this kind of global economic wide effect. You'd need to take that into account when you think about the direction of the US economy, about the direction of key economic variables like growth and inflation.
And what's this other one you were talking about to the team on Monday about, like diversification is a mirage? I thought diversification was, that's still good, right?
Like diversification, the idea that we have different assets in our portfolios that perform differently in different environments is one of the bedrocks of putting together a coherent portfolio. The challenge that BlackRock highlight in 2026 is that the headline approach to doing that is becoming a little more tricky. So once upon a time, you'd look at that purely at an asset class level. So do I have some cash? Do I have some fixed interest? Do I have some shares? All of those will perform a little bit differently. We're seeing some of that kind of headline diversification benefit break down a little, and we're needing to look a bit more below the surface for other diversifying assets. So what does that say? It means you just need to be more subtle and nuanced in how you build portfolios. You need to look at how this world that we're seeing right now affects different asset classes. And maybe to build the most diversified portfolio, we need to look below those headlines of an asset class and look for subsectors within each asset class to build the most coherent portfolio. So it's made it more complex to get great diversification.
And I guess to work with, managers as well as opposed to trying to, good managers as opposed to trying to pick it all yourself. Let's talk about one of those subsectors that you referred to, infrastructure. Now, you talked on Monday about this as well to the team, but, are people missing is this an unloved or unknown kind of, thing at the moment? Everyone knows about chip stocks, memory stocks maybe, or AI if you're sort of, taking it a step back out, but Are people missing the wood for the trees, and is infrastructure a really kind of important thing that people aren't paying enough attention to?
Yeah, so you can hardly say it's not an understood asset class, but the way that we tend to look at these things to get a sense of how excited the market is by a theme is to look at the valuation of those types of companies compared to the valuation of other types of companies. So, are those companies looking cheap? Are they looking expensive? Are they looking about average? The exciting thing for infrastructure for us is we know the world needs to keep investing in infrastructure. We know that we're trying to go through a transition to a lower carbon economy. We know that AI requires massive infrastructure development to support the electricity required to run these models. But yet those assets are trading at relatively cheap valuations versus the broad market. So we think that makes it a really interesting investment destination. Good cash flows, they tend to be related to inflation. So if inflation jumps, those cash flows jump, but yet you're not paying a very big price for them. So they're an attractive asset. We've got them in our portfolio right now. And we think that is an area for investors to consider when they build their portfolios.
Hey, I just realized one theme I didn't touch on from kind of, those BlackRock themes at the start that I neglected to mention was this concept of leveraging up. We know leverage, and that's not pumping things full of, debt. That's more in terms of, I guess, leverage being debt is an impact on companies and governments around the world. We know there's a conversation at the moment heading into the budget around, New Zealand's debt and different perspectives, different parties having it. But Frank, what does it mean, I guess, from your seat, the leveraging up concept is focusing on what exactly?
Yeah, so the observation here is that between governments and companies, we're seeing a little more debt in the economy. So governments around the world are still running fiscal deficits and still borrowing increasingly large amounts of money. Companies, and this does tie into the micro is the new macro idea, but the technology sector, which used to be a big provider of cash to the economy, is now actually borrowing a lot of money to fund the development of data centers. So they're borrowing a lot of money as well. And so what we're seeing is just an economy-wide growth in the level of debt. That's a risk factor that we do need to ponder when we build portfolios. More debt means more vulnerability to companies and economies, and it's just something that we need to really monitor very closely. So some of these things are opportunities, some of these things are risks. We need to take both into account when we build a portfolio.
And I guess that goes back to the sort of that there's different definitions of diversification now, isn't there, in terms of looking a bit more under the hood. So one thing I want to I guess get to before everyone gets into their weekend is, because it is right to have a conversation on it again. Chips, memory, technology, AI, it has run very hard since, I would say, sort of that Middle East and the latest crisis there. Off the back of that, things have gone pretty parabolic, meaning straight up. Are we ready to have that chat again on are things overextended? And I just want to refer to, this yesterday morning, Cisco reported, after hours, and it talks about its backlog and things, and it's, up 15% after hours. Is it a simplistic thing to say, are things in that B word, or is it different this time?
Yeah, for me, there's always subtlety and nuance that you need to take into account. So I have a bit of an allergic reaction to using that B word, or frankly, labeling markets as one thing or another, because there's always information that you need to take into account. When we look at the kind of AI complex, at least for now, and all of these things need to be taken with caution, but at least for now, the hyperscalers, their earnings are coming through in line with the investments they're making. So that's really good news. They're generating a return on investment for the investments they're making. So that's, I think for now it'd be very hard to conclude with that background that is a bubble in that space. Other parts of the market, there does appear to be some more, shall we say, aggressive pricing being brought in. And semiconductors is a really interesting one. Historically, it's been a phenomenally volatile and cyclical area. What does that mean in practice? It means when demand goes up, unfortunately, supply responses kick in, and eventually too much supply gets built, prices fall, and those stocks crater. And it's been a graveyard for investors over the years trying to pick those cycles. It's different this time is being used a lot to justify the current rally, and the argument, we touched on this last week, but that AI needs a lot of high bandwidth memory chips to run the inference models. That demand will be there for some time. The supply is not able to meet it. So therefore, prices, margins, and share prices have gone up dramatically. History would tell you that won't last forever. It's not impossible to build new fabs or
fabrication plants
factories to build these chips. I presume CFOs around the world are looking at the returns on offer and are starting to think about meeting that demand. So, yeah, I think whenever a sector has got cyclicality baked into the cake, you just need to be that bit more cautious as an investor and get your timing absolutely spot on. And as we know, that's really hard to do.
Yeah, and I guess it's you want to participate. You should participate in big trends like this, but maybe don't bet the farm, right? So it's kind of like you're not going to be able to pick when that point is. But as long as you're not, wedded one way or the other, you should be, you should be fine.
Yeah, but you just need to be conscious that when people change their mind, the door that everyone is running for is very narrow and not. And you don't want to be the last one out of it, put it that way.
An article I spotted this week, which was really, really good. You're a real, I guess, proponent of and user of AI in terms of where it's at currently and its capability and how it can supercharge you. But I saw a great article this week out of the team at Bailey Gifford, which is an investment manager, I think, in the UK or Europe, and sort of just gave us a different perspective. AI isn't coming for your job, it's coming for your mind. Pause for dramatic effect. But, a wonderful article, and I posted it to LinkedIn as well. You can have a look at it. But the central point it made was that, AI, it improves immediately, sort of the immediate task you're working on, but it can degrade, I guess, that long-term human capability that's built up over generations and eons and eons. You get better results today, but become less capable tomorrow. I thought that was the antithesis of kind of investing. I guess, did you ever thought, I guess, on we talk about the investment side, Frank, but I guess the flow-on effects to us as users of it, is there anything you have top of mind at the moment?
Yeah, and look, I should be less boring, but I've got to talk about the investment side of this, not so much the stocks, but how is AI beginning to change and influence investors and investment processes? And it's a tremendous article. One of the core elements of the article, and I do urge you to read it, but they argue that the structure of our brains changed when we learnt to read, and that the way that we process information in a written form is very different how we process visual information. And the thesis is that the same thing will happen if we use AI really heavily in our thinking. And I think this does speak to the sorts of things that I think the smartest investors in the world are doing with AI. So make no mistake about it, AI is incredibly present in the way that the smartest investors in the world invest money right now. And there's almost two distinct camps there. There's the systematic quantitative managers who've been using AI or AI variants for a very long time. They are phenomenally sophisticated in how much data they can manage through that, really using it to analyze vast quantities of data and look for very small signals that point to future stock performance. Those kind of managers have been using AI for probably 15 or 20 years. But the sophistication just keeps going up and up and up on this. I was speaking to somebody earlier in the week on this exact topic, and they were talking about a 3-step model that they use, that they suck in strategist research and identify common themes across different strategists. They then use another model to consider baskets of stocks that would be good long and short positions on those particular themes. And then they port that into a third model to do the bottom-up research on those names to make sure that there's no kind of subtlety bottom-up information you should be aware of, and then use that to inform portfolio construction. So, the sophistication is unbelievable. That's less relevant to this conversation, but I thought it was kind of interesting to drop in anyway. But it's where the fundamental managers are using AI. So again, what's a fundamental manager? They're the kind of bit like I was in my previous career, visiting companies, analyzing balance sheets, doing kind of really sort of grunty bottom-up research. Increasingly, AI is being used as a tool to assist in that research. And I think this is where the Bailey Gifford article really resonated for me, is that when you use it as a tool, it can be tremendously useful.
Yes.
When it takes your brain over, it can start to really not help you make great quality decisions. So I think the discipline for all of us in this will be to use AI in a way that's appropriate, that assists our ability to learn, that enhances our research processes, but doesn't take over our critical thinking. And I think that'll be where the line needs to get drawn. Be quite hard to do that. You got to be really disciplined, but really critical. And I think the Bailey Gifford article is a great kind of lead on that.
Yeah, and I think the article for anyone who, it's a great application for investing, but also as a mum, dad, user, someone a child, it'd be worthwhile looking at it to see actually, what am I using this for and how can it help me? Frank, we'll wrap up here. Let's end with any Friday reflection going into the weekend. I've got one, but you first. Anything that's on your mind going into the weekend?
No, you go first, Nigel, and then I can think of one.
I'll put you on the spot. My one was I saw a great just a throwaway comment on a podcast I was following during the week, which was sort of said that when you listen to a podcast like this and content, we talk about throw things around and we talk about all the latest thought leadership and what's on our minds, but you can listen to as much of that as you want, but if you don't have the right investing mindset, it could be the zero in the equation, meaning that a first headline comes, you can be as smart as you want with all this insights, but if you flee to cash, as soon as a negative headline comes up, it's all for naught. So I think it just seeded for me the need to do a topic on that. I think maybe around the psychology of investing, or we could get in. So that was my thought, and I thought that was a really good learning.
No, that is a good learning. And look, my son turned 10 this week, and I did read the Bally Gifford article that you sent through, Nigel, and been doing a lot of thinking around that. And it is it's kind of fun to ponder the world that our kids are heading towards. It's going to be a different one. It is going to be a different one.
Look, that is a very poetic and poignant way to end. I just was watching you say that while you were surrounded by autumnal colours in Queenstown. I thought it was very, very sage. So with that, Frank, look after yourself this weekend. Have a good weekend, and we'll talk to you next week.
Brilliant. Thank you, Nigel.
All right, and thanks everyone. Tune in next week. We'll see you for another edition of the ASB Investment Podcast and another edition of Fridays with Frank and Associates. See you then. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.